GST impact on rates, there should be a single rate for everything, says Vivek Debroy. www.financialexpress.cust impact on rates, there should be a single rate for everything, says Vivek Debroy today, 5:16 a.m. Exemptions mean loss in revenue. In FY16, such concessions, incentives on excise duty had a revenue impact of Rs 24,940 crore. What is a good and simple tax and why is the present indirect tax structure bad and complicated? There are several reasons behind the bad, ugly and complicated visage, the constitutional structure, history and legacy, differential treatment of goods vis-a-vis services, multiple rates and exemptions. Exemptions mean loss in revenue. In FY16, such concessions, incentives on excise duty had a revenue impact of Rs 24,940 crore. Stated more directly, had those concessions, incentives not been there, revenue would have been that much more. In February 2016, there was a parliamentary question and, in response, the government gave figures for September 2015 to 136,365 indirect tax cases were pending, 40,967 before Supreme Court. The total sum involved was backward to 11,881 crore. Differences in rates across items are a primary reason behind tax disputes. Ponder the following weighty matters. Is green coconut a fruit or a vegetable? Is parachute oil occasionally used for hair too? Coconut oil or hair oil? Is Dank Manjan Lal tooth powder or a medicinal product? Is McDonald's Maxwell ice cream or a dairy product? Is Scrabble a game or a puzzle? These, and there are several more examples, are matters on which courts have had to adjudicate because of differences in rates. Other than prohibition, differences in rates are the reason behind liquor being smuggled across borders and cars being bought and registered in a state other than the state of residence. Simple is a simple and objectively determined adjective. Across goods and services, there should be a single rate for everything and no items should be outside the tax net. You do not leave out liquor, petroleum products, electricity or legal services. There is also a trade-off between simple and good, good being a term that is inherently subjective. Specifically, should indirect tax policy be used to address distributional concerns? Distributional concerns are indeed important. However, some issues of equity are beyond the purview of tax policy. To the extent they are in the domain of tax policy, they pertain to direct taxes, where progressivity can be built in. But in many developing countries, India included, there is a perception that indirect taxes must reflect concerns of the poor and deflect items consumed by relatively rich. As soon as this thin end of the wedge is in, one is asking for trouble. Mass consumption and elitist consumption involve subjective identification, based on static and arbitrary considerations. It also allows the insidious creeping in of lobbying for exemptions. Why did the excise exemptions mentioned earlier exist? Probably because someone lobbied for them. The exemption argument is simple. Remove exemptions for others, but retain them for me. Think of the following items and ask whether they deserve a GST rate of 0%, even with that pro-poor lens: meat, fish, newspapers, printed books. Everyone wants a lower tax rate, more on that later. But should the items mentioned, and there are more like that, be given a 0% rate because they are essential goods and services? Roughly 300 items in the center's list and 80 items in the state list have such 0% rates. Why create an artificial threshold of backward 1000 between hotels that have higher room tariffs and lower? There is another threshold at backward 7500. For garments, there is a threshold of backward 1000 and for footwear, one of backward 500. Is shampoo a demerit good to be taxed at 28%? A revenue neutral rate is a rate that yields the same revenue before and after the change. Computing a revenue neutral rate isn't easy because it's hard to estimate volume growth growth and a broadening of the tax base. In all probability, with all items under GST, a revenue-neutral rate would have been around 17%, perhaps even 18%. With several items at 0%, 3%, 5% and 12%, the weighted average rate of items included is probably below 18%. Make no mistake, introducing the GST in a country like India is no mean achievement. Few countries, around 7, have the GST, though several have VAT. Of the ones that have the GST, Canada and India are probably the only ones that have some kind of federal structure. Of course, many union and state taxes, central excise, service tax, VAT, entertainment tax, octroi, entry tax, purchase tax, luxury tax, taxes on lottery, have been unified and interstate checkposts are vanishing. The GST brings gains, efficiency, and thereby growth, lower compliance costs, lower collection costs and greater tax revenue. But empirical evidence on VAT indicates such gains happen when all items are included and there are no more than 2 to 3 rates. In working out the compromise, GST Council has deviated quite a bit from that goal. Concerns about rules, e-way bills, registrations, forms are not that serious. They will sort themselves out with tweaking here and there. Concern about the basic structure is more serious. Sure, there is hope that in the long run, there will be no more than 2 or 3 rates, a standard one, a merit, lower, and a demerit one, higher. There is the Keynes quote and let me give you all of it, not just the bit that is usually quoted. The long run is a misleading guide to current affairs. In the long run, we are all dead. What are those 3 rates likely to be? Probably something like 12%, 18% and 24%. Everyone will happily accept reduction from 28% to 24%. No one will happily accept increase from 0%, 3% and 5% to 12%. Had it been that easy, the GST Council would have introduced it now. Once in place, a basic structure is not that easy to change, nor its consequences. Many old English houses continue to be dark because glass was heavily taxed, discouraging use of windows. Old houses in Amsterdam are narrow because taxes on houses were correlated with width of the facade. Similarly, on the basis of present rates, enterprises will take decisions and argue against change, even though promissory estoppel doesn't apply to taxation. Read, post comments visit website. Railways subsidy surrender plan, here is what may derail the effort. www.financialexpress.com Railways subsidy surrender plan, here is what may derail the effort. Today, 5:07 am under recoveries across classes in both non-suburban and suburban rail services, the concessions given to specific groups, non-suburban, and resulted in a loss of a little over Rs 33,000 crore in FY15. PTI, the government might be looking to replicate the success of its #GiveATube campaign for LPG subsidy for railways fare subsidies, but that may prove to be a different ball game altogether. Under recoveries across classes in both non-suburban and suburban rail services, the concessions given to specific groups, non-suburban, and resulted in a loss of a little over Rs 33,000 crore in FY15. Thus, the government planning a campaign to get passengers to renounce subsidies should seem to be a good idea. As per the Times of India, giving up will be offered in 2 slabs, 50% and 100% of the subsidy amounts. The bulk of the operating losses to the passenger business of the railways comes from under recovery across classes in non-suburban and suburban services. It is likely that first and second AC passengers, first AC fares are comparable with flight fares, will be able to afford a full charge or an increased charge if they opt for the 50% subsidy surrender. But, while it is true that the railways incurs a loss in the first and second AC segments, and makes a profit in third AC, it is the sleeper and the second class, largely unreserved, passenger segments where under recovery hits it the hardest. A study on railways' cost of fulfilling social service obligations by Niti Aayog's Bibek Debroy and Kishore Desai shows these segments in mail, express and ordinary trains accounted for Rs 27,770 26 crore of the total Rs 27,779 crore operating losses the non-suburban service incurred in FY15. In fact, Debroy Desai point out that for the Delhi-Lucknow route, fares in sleeper and second-class work out to less than half of what bus services offering comparable standards of travel charge. The suburban and Kolkata metro service, for their part, accounted for a loss of Rs 4,679 crore. Given the likely income bracket of the passengers in these classes, it seems doubtful that the government will be able to get passengers to give up the subsidy where it matters the most. Perhaps, homeopathic fare increases could work better. That said, the railways could cut losses if it were to shed a bulk of its first and second AC segments and offer more third AC coaches, since that is where the profits are. Read, post comments visit website. Small savings rates, why government must bring parity in returns of all financial products. www.financialexpress.com Small savings rates, why government must bring parity in returns of all financial products today, 4:56 am. If rates on small savings were to come down, the tax breaks on many make them even more attractive. Banks would be in a position to lower deposit rates and, therefore, lending rates. When the government, in March last year, announced the plan to reset interest rates on small savings every quarter, most thought it would usher in an era of low interest rates, in keeping with the falling rates on government securities, G-Secs. As the government press release put it, the move is expected to help the economy move to a lower overall interest rate regime eventually and thereby help all, particularly low-income and salaried classes. If rates on small savings were to come down, the tax breaks on many make them even more attractive. Banks would be in a position to lower deposit rates and, therefore, lending rates. The problem, however, is that despite the announcement, even spreads over G-Secs were announced like, for instance, 75 bits per second for the Sukanya Samriddhi Yojana and 100 bits per second for Senior Citizen Savings Scheme. Rates have not come down commensurately. Which is why, in February, RBI said interest rates would come down faster if rates on small savings came down. These rates, the central bank said, are about 65 to 100 basis points higher, compared to what they should be if the formula is followed. So while the government has cut rates on small savings by 10 bits per second for the second successive quarter, the interest rate on the tax-free Public Provident Fund (PPF) has been set at 7.8% for July-September after factoring in the 25 bits per second spread that was announced for this product. The rate should have been around 7%, an 85 bits per second extra return, apart from generous tax incentives, makes the PPF far superior to anything a bank can offer. While SBI offers 6.25% on a 5-year deposit, the same scheme in a post office fetches 7.6%, a full 55 bits per second higher than it should be based on the formula announced by the government. A 5-year NSC offers an even higher 7.8% interest rate, which is 75 bits per second more than what the formula warranted. At a time when inflation was high, the government wanting to protect those investing in small savings rates still made sense. Today, however, inflation levels are at almost historical lows, making the real return much higher than in the past. With CPI at 2.18% right now, the 5-year NSC has a real return of 5.6% and the Sukanya Samriddhi Yojana offers 6.1%. Apart from the fact that not cutting rates enough is hindering monetary transmission, from the point of efficiency, the government must adhere to its own set rules and bring in parity in returns of all financial products of similar risks. Read, post comments visit website. Digital payments, with BHIM downloads behind targets, here is why regaining momentum is critical. www.financialexpress.com Digital payments, with BHIM downloads behind targets, here is why regaining momentum is critical today, 4:50 am. This does not mean that digital payments are back to their pre-demonetization levels. Indeed, there was a big momentum in digital payments even before demonetization. With cash flowing back into the system over the last few months, the average number of digital transactions per day has slipped from 44 million in March 2017 to 37 million in June, according to a recent presentation made by NPCI chief AP Hota. This does not mean that digital payments are back to their pre-demonetization levels. Indeed, there was a big momentum in digital payments even before demonetization. At Rs 75,100 crore extrapolated over April, based on RBI's representational data, usage of debit, credit cards at retail outlets in May 2017 was below the December 2016 peak of Rs 89,200 crore, but way higher than Rs 40,500 crore in May 2016. The use of PPIs doubled in December and, to that extent, May 2017's Rs 11,500 crore looks sluggish, but it is dramatically higher than May 2016's Rs 5,000 crore. IMPS transactions have slowed in the past few months, but at Rs 58,600 crore in May 2017, they are 2.7 times more than the Rs 21,600 crore in May 2016. The question, in this context, is what does the government need to do to achieve its digital payments targets? Particularly worrying, in this context, is Hota's data that shows the number of BHIM downloads is down from 6.8 million in January 2017 to a mere 0.6 million in June. As a result, while the target for OP plus PIM is 40 crore transactions in FY18, the actual achievement in Q1 was a mere 2.5 crore, or a little over 6%, for all digital transactions, against the target of 2,500 crore for FY18, the achievement for Q1 was a mere 230 crore. Given households, small traders and small businessmen are all more comfortable with cash payments, the fact is the government hasn't spent enough time and resources in effectively promoting the use of digital channels. Since banks have always been reluctant to promote the OP channel for fear of losing customers, the channel can be accessed across apps and will remain reluctant. It is up to the government to up the ante. The Digithan Meller initiative might boast of 27 lakh merchants coming on board and more than 20 million individuals registering, but this is not reflecting in the number of transactions. What's called for is a far bigger initiative. Watch this also. The government needs to create a separate organization and give it a large enough budget so that it can make the channels user-friendly, much like PATE has done. Promoting digitization requires a more focused approach, with professionals doing the job rather than bureaucrats. The BHIM app, for instance, is a simple enough product but far less popular than a PATE because it hasn't been promoted enough. The product needs to be pulled rather than pushed, but for that to happen, customers must be convinced of its benefits. Since, for instance, some of Paytm's attractions lie in the tie-ups with cab aggregators and the cashback offers, a BHIM too needs to be made more attractive with such deals and more. Some part of the problem, of course, is linked to the desire to avoid tax payments, but once GST stabilizes, this should be less of a problem. The government, meanwhile, has to continue to push digital payments, and that means both addressing pain points for users and, like PATE, finding new ways to lure them. Read, post comments, visit website.